And this looks like the makings of something big. There's only 7 stocks. The truth is that it's not just 7 stocks. It's hundreds of them ripping in your face the whole year.
Chartmaster JC Parets from All Star Charts joins us today to talk about Bitcoin, Tesla, tech stocks, commodities, and more. I'm Ed D'Agostino, and this is Global Macro Update from Malden Economics. JC, it's great to have you here, man. I really appreciate you taking some time.
Sure, anytime. Listen, you want to talk about markets? This is what we do.
I want to talk about markets. Malden Economics, we're kind of a macro shop, right? That's what we're known for. You're a technician. Before we go into the markets, I just want to make sure, because a lot of people might not be used to hearing from me and a technician at the same time. How do you look at the markets? What's your time horizon? How do you measure when to get in and when to get out? Because the macro world tends to be different than I suspect how you approach markets and trading.
Yep. So it depends on the strategy, right? So for me, I've studied this for a long time. I participated for a long time. Real diversification is having a variety of different strategies. And, it depends on where you are sort of in your progression of your, sort of life and overall net worth. And, maybe you're looking to be much more aggressive than having a variety of different strategies, right? Like everybody's in a different place in time. Like, I have a house and I have 3 kids and, we got college things that I'm worried about and there's strategies for that. And then I have others where we're collecting income with those strategies and then, maybe buy a beach house and then rent it out or maybe not and then just have it for ourselves. Like there's other decisions that we have to make in life that essentially determine what is the best way to allocate the assets. And what's right for me is certainly not going to be what's right for you. And, what I've learned is having some more quote unquote conservative strategies allows me to perhaps be more aggressive in other areas where if it was my college kids' money, I'm not going to be putting on a risk reversal in an Asian internet stock that could potentially gap down and really cost us. But in a different account where that's specifically what we do, then we're going to be okay doing that. I have longer term strategies, and then we have a great day trader at All Star Charts. Her name is Kimmy Sokolov, and she crushes it. So I day trade like in the first half an hour to hour of the day as well, and I mix that in. And that has absolutely nothing to do with my wife's and I retirement account, right? Where we are putting money in the S&P 500 every single month because the S&P 500 is the greatest momentum strategy of all time. It buys more of the best ones and it kicks out the worst ones. Like, that's fantastic. I'll do that every month until I retire in that particular account. So there's a time and a place for everything. In my options account, what I'm doing is I'm selling strangles every day. We take the most liquid 30 ETFs out there. You know them all, EEM, SPY, you know them all. The most liquid 30, the ones with the highest implied volatility, we sell a strangle. Out of the money call, out of the money put, collect the income. Very simple. We just do that. Where we can collect the most, we do. And that's what that strategy is. And that strategy looks out 40 to 60 days, right? So, anyway, there are different time horizons for different strategies. And depending on the conversation we're having, we can sort of dictate that. At All Star Charts, the work that's done, that we do starts from the top down, right? And we're looking at charts that go back 100 years, 50 years, 30 years, 20 years to get structural perspective on where we are in the cycle for various asset classes, including the stock market, the bond market, the commodities market, precious metals, crypto, understanding how they're all tied with one another because it's just this beautiful dance is what the market is. It's not the U.S. stock market. It's the stock market, and there's a lot of countries outside the United States, right? And it's not like, I live in Texas, so I buy American stocks. It's like, no. You can live in Texas and buy American stocks, but if there's no reason why you shouldn't buy Novo Nordisk because it's Danish. Who cares? What does it matter that Petrobras is from Brazil? If line go up, we make money. It doesn't matter. We're buying right on the New York Stock Exchange. So it's a global market. And if you think that interest rates are not pushing and pulling the direction of those stocks, then you are crazy, right? Every cryptocurrency in the world can go to zero tomorrow and it will not matter. Every single pot stock ever could go to zero tomorrow and it will not matter. These are irrelevant markets. The bond market is $120 trillion, right? So wherever the bond market goes, it's going to bully around the other asset classes, particularly stocks and commodities. So it really starts there. So we do a lot of analysis on the interest rate markets and credit spreads and yield curves, et cetera, et cetera. And all of that affects different sectors of the stock market differently. So let's say you're never going to trade a bond in your life. Fine. But understanding the direction of rates and what's happening there is going to help you determine whether you should have a higher allocation perhaps to growth stocks, or perhaps a higher allocation to the more value-oriented areas like industrials if interest rates are rising. And there's a time and a place for everything. I'm a growth investor. Why are you a growth investor? Because growth stocks outperformed for so long? I only invest in the U.S. Why do you only invest in the U.S.? Because the U.S. was outperforming this whole time? Like, there's an element of recency bias combined with home country bias that I think a lot of investors, particularly new ones, but investors that have been doing this a long time, fall into that trap also. So it's not just new investors falling into that recency bias trap. So we start bigger picture and then work our way down to more intermediate term time horizons, looking out, weeks and months, right? That's sort of where we live. And then we've added additional short-term layers like, day trading with Kimmy and the option stuff that we do too.
Okay, so in general, weeks and months is kind of your time horizon.
Sure. As far as the analysis that we do for our research that we put out to our customers, that's exactly what it is. Yep. With bigger picture for structural perspective, and then looking out daily timeframes on charts, looking out weeks and months for tactical opportunities to profit.
I loved your answer. That might have been the best answer I've ever received about just kind of how you should look at investing, because that's, I think, what trips up, especially new investors right away. Like, give me your best idea. I can't answer that without asking you 15 questions, or I would be grossly negligent, right? So we set the stage. That was awesome. Now, let's dig into some markets. What are you seeing? Is tech still dominating, and do you see that continuing?
Yeah, so let's see. I was just actually pulling up the stats as we started the podcast. So the market bottomed. Today is June the 26th. So the market bottomed on June the 16th of last year. That is when the list of new 52-week lows list peaked. Since then, it has been just a steady progression, healthy sector rotation that we're seeing. Off the lows last summer, the leaders were really the more value-oriented areas as interest rates were going up, things like industrials, financials, energy, as you know, materials were really, really outperforming in the back half of last year, as opposed to the more growth-oriented areas like technology and communications, consumer discretionary on a cap-weighted basis, so more like Amazon and Tesla, and less on an equally weighted basis. In fact, consumer discretionary on an equally weighted basis led off the lows last summer. So you had the more value-oriented areas plus an element of discretionary leading the back half of last year. And then what happened this year? You got that sector rotation. The laggards caught up to the leaders, right? In bear markets, what happens? The opposite. The leaders catch down to the laggards, right? In bull markets, the laggards catch up to the leaders. This is what you see. Go back and study, 100 years. That's what happens. So then it became a situation where it's like, oh, JC, it's not a bull market because, tech's not, participating, and, Tesla's not working, and like nobody cares about Peru, JC. People trade growth stocks. Okay, fine. Now this year, oh, it's only the growth stocks that are working. Oh, it's only, there's only 7 stocks, right? But we know the truth. The truth is that it's not just 7 stocks. It's hundreds of them ripping your face the whole year. Because you got that rotation, and now we're getting even further rotation into small caps and industrials and other areas as well. So just that consistent sector rotation, new areas of the market emerging as leaders. The fact that the United States is an underperformer this cycle is perfectly normal, right? Go back and study bull markets for 100 years. You know what you're going to find? You're going to find the United States was an underperformer in a lot of those. So the fact that, you're seeing Europe and other developed nations, Japan, absolutely crushing the United States, that's not a bad thing for U.S. stocks, right? It's not, you're getting people who are like, oh, weak breath. Fucking Germany's making new all-time highs. What weak breath? United Kingdom, France, Denmark, Japan making new 33-year highs. Do those 7 tech stocks also trade on the Tokyo Stock Exchange? And I'm not aware of it? What about the cruise lines that have doubled this year? Are these cruise lines now all of a sudden using artificial intelligence algorithms also? Like, what are these people looking at? Home construction stocks, just all-time highs every day. Like, what's 7 stocks? Like, I think these people are losing their minds, man.
I think that what's happening in Japan is probably the most fascinating out of all. After 33 years of just nothing, do you see that being sustained?
Yeah, I mean, listen, we're still nowhere near the 1989 highs. I mean, that was crazy. It was the late 80s. This one park in Tokyo, the land was worth more than all the land value of the state of California combined. Like, that's crazy, right? And by the way, I've been to this park. It's a lovely park, and I'm obsessed with Tokyo. So, Japanese, do not take this the wrong way. But I mean, that park worth more than all of California? Like, that's something's wrong there. It's a lovely park, but the whole state of California is a little aggressive. And it wasn't like this was 100 years ago. This is in the late 80s. Like, that's insane. So anyway, it takes a long time to sort of correct these bubbles. And here we are 33 years later, and we're still not back at those levels. So when you talk about the biggest bases in the world, that is certainly one of them. Newmont Mining on the gold side is probably another one that hasn't done anything since the 80s. So huge bases with all the potential in the world. And Japanese equities have been working.
You were at our strategic investment conference back in early to middle part of May. One of the big ideas coming out of that conference from a lot of the macro people was energy, specifically oil, petroleum. People were really, really bullish on energy, and it has been a painful trade so far for them. What are you seeing in that sector?
So what I'm seeing in energy just in general is a lot of potential, but no activity just yet is probably the best way I could put it. As we were recording up a little bit, but all the potential in the world, because these are the 2018 highs, right? These are the 2018 highs, and we're back to the scene of the crime. So it's kind of one of these things where does crude oil, does it hang in there? As technicians, we're taught former resistance turns into support. Yeah, potentially, right? Because where there was an overwhelming amount of supply for oil in this case at these prices, when prices were able to finally exceed that after 2022, we know from experience the ability for prices to exceed those former levels was because demand was ultimately able to exceed that supply and prices were able to move on. So on any return back to that level, if history is any evidence, there's more demand than supply at these levels. And we're seeing that, but we haven't seen enough demand coming in to really take it higher. We've just seen enough demand to stop it from going lower. Right? You see the difference? So, and, kind of like the stock market, I talk about it, last summer, the first thing stocks need to do before they can start to go up is to stop going down, right? And that happened last summer. In the case of oil, you can kind of say that, over the last year or so, year and change, we stopped going down in crude oil several months ago and are, just consolidating and just trying to find its footing. Hasn't gotten going yet, but I think it's worth a look. So here's crude oil. As you can see, that's exactly what we're referring to. Interesting information, when you're curious, hey, what's the market going to do? Look at its brothers and sisters and cousins and, stocks in that group, or in this case, commodities of that group. What are they doing? And what you're seeing is heating oil futures and gasoline futures still holding on to those former highs. So it's not like we could say, okay, oil's going to break because heating oil and gasoline, these things are breaking. So like crude is next, right? You're seeing these hang on. So, maybe one breaks and then the others follow, or maybe they all just hold. And these are great indicators for crude oil itself. So I would keep an eye on that. Also, I would argue the resiliency in energy stocks, despite the 40-something% correction in crude oil futures, to me is one of the more interesting factors, most definitely. I think Warren Buffett continues to see that. He keeps buying this Occidental Petroleum. He continues to file Occidental Petroleum about 2.5% today. That's probably Warren Buffett. It's funny because Warren Buffett has literally been support for Occidental Petroleum. Every time we see a rip, it's like, oh, is Uncle Warren filing again? Sure enough, we see the filing coming in. And of course, it's Uncle Warren. So look for a breakout in energy stocks. This XLE, you got a lot of Exxon and Chevron. Not that there's anything wrong with that. That's the energy market. So just keep that in mind. It's holdings. But I think a breakout there, finally, still below the '08 highs, guys. So, people are like, oh, energy's overextended. Yeah, maybe short term, but energy hasn't even broken out yet. People are like, what do you mean energy hasn't, not these days, but like when energy was really ripping, it's like, what do you mean it hasn't broken out? I'm like, yeah, hasn't even broken out.
Well, when you say Exxon and Chevron, so does that mean, am I inferring that you prefer the smaller caps in the oil companies?
Well, I think it's more of a beta play. What are you looking for? We're all into different things, right? I like my steak, medium rare. My I like ribeyes. Other people like filet mignon, right? It's just different. Like, I'd rather not eat steak if you're going to give me a filet, me personally, right? I'd rather eat freaking anything but a filet mignon. You know, whatever. There's nothing wrong with that. That's just me. So for you, you might be like, oh, you know, I'm going to own the Chevron. This thing's a long-term trend. Warren Buffett's buying a ton of it. I'm going to collect a dividend, and that's great. And there's nothing wrong with that. And then somebody else is going to be like, I'm going to buy the $6 offshore driller that I'm going to get a 3-bagger on this thing. Right? And then somebody else is going to be like, you know what? I'm going to put on a bull call spread on ExxonMobil, and I'm going to, you know, put the probabilities on my side, cap my upside, but I'm okay with that. Lower risk. You know, I know what I'm getting, right? So there's a time and a place for everything. And depending on what you're trying to accomplish, you know, for me, and we're you know, part of the value that we bring to the table, in addition to the idea flow, is really putting things into context, right? Like if you're in the, you know, Occidental Petroleum warrants, you know, you're probably going to do much better than my Chevron common stock position, right? But you're being much more aggressive. And if that's what you're trying to do, then you're going to be bored to death in the Chevron common stock. You know, buy your Oxy warrants, you know, you go, right? You do your thing. You know what I'm saying? Like, so there's no wrong way to do it. It's more about getting the theme right, in my opinion, and the execution. Maybe you buy oil futures. I mean, you know, like everybody has a different flavor.
Fair enough. Now, I didn't mean to interrupt you. I think you were going to move on to different energy sectors.
I mean, listen, I think you're seeing a similar picture out of coal, right? So, of course, the geniuses over at the ETF companies took out the coal ETF right before coal started ripping. Classic. The old KOL, rest in peace, KOL, one of my favorite ETFs back in the day. And so we made our own ETF here, just equally weighted, you know, a lot of the coal stocks. And as you can see, kind of looking very similar to crude oil futures itself, right? You got your highs in 18, ultimately broke out and now sort of retesting. You're seeing that in coal. This is an equally weighted index that we just created just to show you how strong the correlations are. These are 2018 highs, and here we are holding above those levels. So it's just sort of a very similar situation. Look at Warrior Met for you old schoolers like me that traded in prior cycles back in 05, 06, 07. You know, Walter Industries, if you recall. The Walter Industries was a mega cap name that ultimately disappeared when that cycle was over. This is them. Warrior Met, HCC. This is those guys. So check that out. Look at Console. You know, that's above 75.5 CEIX. CEIX down on the day, breaking out above 76. I like this long. Still has some work to do, but sort of putting in a nice little base. And then gold really just can't get out of its own way. You know, even with a weaker dollar, just really haven't been able to see anything this year. This was a back half of last year's story, particularly in the fourth quarter. Still haven't been able to see it go. Gold has already broken out to new all-time highs for quite some time when you price it in other currencies. And not just Japanese yen, anything looks good if you price it in yen, but in euro, British pounds. Gold's making new all-time highs if you price it in U.S. Treasury bonds, Canadian dollars, Aussie, Kiwi, Indian rupee. Pricing in all those currencies, it's lower left to the upper right. So I'm in the camp that ultimately gold follows in price in U.S. dollars what it's already been doing in those other currencies. So that's what I'm keeping an eye out for. And copper stopped going down as well. So if copper can get its footing here, I think that bodes well for the overall market. Seeing some of these uranium names. One of the things you see in bull markets is new types of names start to emerge, new groups of leaderships. New like, oh, have you seen these stocks? Have you seen those stocks? Those conversations are not had in bear markets. Cameco consolidating here. If we can get a breakout above 32.5, that looks good. This is Linde. This is the largest chemical stock in the world. Continues to act really, really well. This is a British stock. Technically, that's where it's listed. I think they're from Massachusetts or something and have like some German or Swiss in them or something like that. Like, I think it's like one of those fugazi British companies. It's just listed there. It's not actually British. Whatever. The point is, it shouldn't matter. It doesn't matter. It could be from Texas. Who gives a damn? It's going from the lower left to the upper right. 180. This thing's a monster, by the way. And then, of course, Tesla has been a beast all year long, one of our best trades until recently. And this looks like the makings of something big. It's consolidating now over the last couple of weeks, but that comes within, something much more substantial, that I think could get going. So that's coming from the consumer discretionary space. So that's on my radar. And just to give you guys some perspective, this is the industrial. So looking back to June the 16th of last year, when the list of new 52-week lows list peaked and things have improved, industrials on an equally weighted basis are up 28% since the June lows last year, which is basically a year. Consumer discretionary, equally weighted, up 28%. Technology, equally weighted. So again, not Apple and Microsoft, equally weighted, 25%. This is from last June. Healthcare up 16%, and some of the others rounding out the rest. On a cap-weighted basis, you're looking at technology up 38% since those June lows. Industrials up 24%, discretionaries up 23%, communications up 21%, healthcare up 11%, materials 10%, and every single sector, including financials are up almost 10%, even with the correction this year off of those lows last year. So, as far as, where we are in the cycle, I still have people asking me when the bear market's going to end. And, you can make a really strong argument that it ended over a year ago.
Yeah, Ed Yardeni, I think, was probably one of the few people at our conference that was also making that argument.
Yeah, I mean, listen, if math plays any role in your analysis, I think that would be your conclusion. If you're into, theories and maybe this and what if that and, this, it has to be this way. If you're one of these people that are more like, like Mother Goose and like you just tell stories and like tell yourself stories and stuff like that, and you just eliminate math altogether, then that's one thing. But if you're in the market, you're in the market to make money, right? Last I checked, at least that's why I'm in the market. That's the only reason I'm in the market. So I think it pays to take the blindfolds off and actually look at what's actually happening, not what you think should happen or what might happen or what this guy said is going to happen, but what is actually happening. And that's what we do because we're the house. We are taking advantage of market trends. And one thing that we know for a fact, right, is that asset prices trend. Like maybe the Fed doesn't know what they're doing. Maybe this is the end of the US dollar as we know it. Maybe Biden doesn't know what he's doing or the Trump is crazy or whatever theory you have. Those things may be true. They could be. Maybe they are. Who knows? But we focus on what actually is true. And what actually is true is that the majority of stocks have been going up over the last year, period. It's just math. So the question now becomes, does that trend continue? And do the majority of stocks continue to go up? Do you continue to get sector rotation? Do you continue to see breadth expansion? Or do you miraculously, completely out of nowhere, starting today, start a new trend lower? And everything completely changes to what we've seen over the last year, which we know historically is the much, much lower probability outcome. It could today, the stock market could start crashing tomorrow, right? But we know that the probabilities are the exact opposite of that asset prices are going to continue to trend in the direction that they're going in, which is just simple math, has been up for almost a year. You could bet that it changes today. You can make that bet if you want. We're not. We are purposely spending more of our time looking for stocks to buy. We are spending more of our time looking to put risk capital to work from the long side in both stocks and cryptocurrencies. And we are spending less time looking for stocks to short, specifically from an intermediate term time horizon, looking out weeks and months. Have we been shorting stocks on an intraday basis? Yeah, practically every day, actually, because the day trading, it's mean reverting by nature, right? So we're looking to fade gaps up, in NVIDIA or Adobe for a buck or two to the downside. Like that is the day trade. It has nothing to do with the fact that the trends in tech are to the upside. In fact, the fact that the trends are up is why we've been looking for shorts on an intraday basis, because that strategy is mean reverting by nature. So if you're looking to short, you got to be shorting strong things.
Yeah, it makes sense. And I've been susceptible to this in the past too, admittedly. The bear case is very compelling for a lot of people. And I firmly believe in macro analysis, but it needs to be applied properly. Right? You can't look for problems and then have that paralyze you. You've really got to be able to just factor that into your risk management.
Yeah, I mean, listen, I think there's a couple of ways to go about it. Number one, understand that as humans, one of the reasons that we have thrived as a species is our ability to tell one another stories and pass those on. And there's an inherent natural desire that we have as Homo sapiens to tell stories and be told stories. Like, that's just in our nature. So as investors, it's important to understand those human flaws and be aware of them so that we can overcome them and not let them distract us from what is important, which is to profit, which is why we're investors. And we can't let our need for storytelling get in the way of that, right? So there's a maturity level and an understanding of how we function as human beings that most investors either don't know, and even the ones that do know, still don't apply those, don't try to overcome them, and still fall prey to those faults, right? Heuristics, right, as they call them. So I think that's number one. And number two, if you are fundamentally oriented, if you are looking at the GDP of Brazil, and the election in Peru to determine whether you should buy these copper futures or not, like, great. But I think that there needs to be a certain element. I mean, listen, you do what you want. Like, if you want to blow yourself up, knock yourself out. But for me, I think there needs to be a certain element of timing and trend following. And in fact, I have a lot of friends that focus on economics and fundamentals, and that's great. And one of the best arguments that I've been told is that, you're looking for that monster tidal wave to come. You're looking for that big tsunami that you're going to make a ton of money, but then you use the technicals to identify when it's starting to get going, starting to get priced in, and your knowledge of that particular subject matter, whether it's economic policy or maybe it's a drug that you're a doctor or a scientist and you just know that this cancer thing is legit because you understand the research and the science, when someone like myself doesn't know the first thing about biotechnology, right? And you think you have an edge there, great. But then you could see the actual price behavior of it driving, and it actually, the rest of the market now agreeing with you, right? The idea is to get the market to agree with you later, right? Right.
You can be right intellectually and not make money.
And if you are early is the same as wrong, right? It's not like, right. I'm not wrong, I'm early. No. By definition, that makes you wrong.
I love this. Before I let you go, well, let's get into a couple of more sectors or ideas. You had a great tweet, I think it was today actually, or maybe yesterday, about Bitcoin.
Yeah.
What's the risk of not owning enough Bitcoin? How do you feel about that?
Yeah, I mean, that's, again, getting back to me personally, where I am as a businessman in my career, in my, with my family, like the things that I owe my family, that I, my responsibility to them and everything like that. And I find myself, asking, do I own enough Bitcoin? And I think right now I do. But if we are above 31,000, I don't think I do. I think I don't know nearly enough Bitcoin. So, and I would say, I'm trying to put things in perspective. Of my liquid net worth, I probably have 15-20% almost, maybe, of my liquid net worth. And my, I have a large illiquid. I have some illiquid investments as well that are a big portion. So of liquid stuff, maybe 15-20% right now. I don't think that, I think that's enough for now. I've been fine with that. But if we're above 31,000 on Bitcoin, then I definitely don't have enough at all. I'm nowhere near enough. And because I don't think that the risk is that it goes back to 60 or 65. I think the risk is that it goes to 120.
Interesting. Wow.
So, and I'm not one of these like, 300% returns. And like, I'm not one of these guys, right? Like, I never speak this way, but I'm speaking specifically about the risk of not owning enough Bitcoin and the risk of not owning enough Bitcoin. In my opinion, everybody listening can do whatever they want. I don't really care what anybody else does. I can only speak for myself. You're like, oh, JC, you're just talking your book. It's like, yeah, bro, whose other book am I supposed to talk? I can only tell you what I'm doing and how I look at things from my perspective. And for me, above 31, the risk is it goes to 120 and I'm not in it. So I think there's a few different ways to play it. Obviously, you could just shut up and buy Bitcoin, but there's like say like in retirement accounts or tax deferred accounts where you can't just have like, on-chain transactions and whatnot, at least not yet. Or maybe you're limited in how many you can do. I don't know. There's like a way you can do it, but it's a little complicated, I guess, for me. There's different ways to take advantage of it, like Mara, MARA, Riot Blockchains, MicroStrategies, MSTR. These are the types of stocks that are moving, whether, in MSTR, they just own a ton of Bitcoin. I think they own like 1% of all the Bitcoin or something like that. And then the miners like Riot and Mara, and there's some smaller cap ones too if you're looking for the beta. So and then now there's ETFs that are going to be coming out too now, like Fidelity's getting involved. So I think it's interesting. I'm curious to see, because in theory, all these TradFi, so the kids call it TradFi, all these TradFi companies now getting involved, like Fidelity and Blackstone and all these things, the fact that they're Carlyle, they're all getting behind it, theoretically would be bullish, because they're essentially building the highways for institutional adoption is really what's happening here before our very eyes. So theoretically, that would be bullish, right? I would think. So if the market does not react in a bullish manner or continue to, right? Because a lot of this was, you had this pump coming into all this news. So I get it. Now the market's digesting this news, but its ability to drive through that sort of exhaustion of sentiment, because all this is happy, joy stuff. So if it's not a sell the news event, right? And you can keep going, I think you're going to see this thing at 32, 33 quick. And if you do, then currently where I'm sitting here today, right now, I do not have enough long exposure where I think I am being irresponsible to my own family. That's how I feel about that. How many people are saying, it's irresponsible to my family to not be long enough Bitcoin? I feel that way.
I've never heard it phrased that way.
Someone's got to tell it like it is. That's how I feel. Maybe I'm wrong. But
to your point, the BlackRocks, the Fidelities of the world, I mean, the big players in the markets are coming in now with ETF applications, and it's hard to imagine that not being a huge tailwind.
Right, but the market's down since these announcements, so that's the whole point, right? How does the market digest this? Obviously, it was being priced in, ripped into these numbers, and look at this chart. This is how I look at it. Technology is really ripped. You had a very strong a very strong positive correlation between technology stocks and Bitcoin for quite some time, and with this AI sort of ripper and Apple and all that, technology's ripped, leaving Bitcoin behind. So it's a question of, does technology catch down to Bitcoin? Does Bitcoin catch up to technology? Do they both move? Does Bitcoin rally and technology fall and they meet in the middle? Is the correlation now changing? Because remember, as bull markets progress, what you'll find over time is that correlations come down. It's when during bear markets, during times of stress and volatility, where correlations among stocks spike to 1. Where they're all moving up together, down together, right? And then as the bull market progresses, those correlations come off. So maybe the correlations are coming off because that's just the nature of the market environment as well. So there's a lot of different questions. I'm in the camp that Bitcoin catches up, and it's whether, and maybe it's technology catching down a little bit. Because remember, Apple and Microsoft, as you can see here, are running into their former highs. This is a lot of market capitalization trying to absorb this overhead supply from a year and a half ago, right? So is this going to happen overnight? It could. It did for NVIDIA. NVIDIA ripped right through those highs like it wasn't even there, right? So did Palo Alto Networks, also ripped through like it wasn't there. Now, granted, those stocks, certainly not Palo Alto, don't have the market capitalization of these two behemoths, right? So I think it's going to be a little choppier. But when you look at, my point is maybe there's precedent, right, to overcoming these former highs already. It's not like we're asking Apple and Microsoft, not we're asking, but it's not like market participants longs. Like if you own the S&P, you own these two, baby. So like, if you're long, and I am long the S&P, so I guess I am asking, are we going to be able to break through these levels? Because if they can't, the S&Ps ain't going higher, right? S&Ps are going to churn at best. So, if you're shorting S&Ps, you're shorting these two. You're betting that these things fail. So I think that it's worth keeping a close eye on. Maybe it's technology coming down with that Apple Microsoft exposure and Bitcoin catching up. Is one of the things that I'm looking at. and then the US dollar being the big catalyst there, right? The US dollar weakening over the last few quarters has been a tremendous tailwind for risk assets, particularly equities. A little disappointing, the performance of emerging markets, China in particular, really underperforming in the face of a dollar that's been getting slaughtered. It's really been the strength out of developed markets, particularly Europe and Japan, although some of the others, it's not emerging markets. And while I will have told you that international stocks would be outperforming the US in a falling dollar environment, I would have also said that emerging markets probably would be outperforming the other developed markets outside the US, and that's not happening. So I think that's also an interesting dynamic where are we now going to get that rotation, right? We're seeing some rotation into small caps. Industrials has certainly caught a bid, right? It's not 7 stocks, right? Far from it. It's hundreds of stocks that have been ripping in your face all year long, all over the world, right? So it's not like select stocks are working. It's broad-based and only getting broader. So one would think if this is a strong bull market, with consistent sector rotation, then perhaps some rotation into emerging markets is coming next, right? And you're seeing emerging market currencies already making new 52-week highs. Come on, Jay, do we have it? Boom. Emerging market currencies making new 52-week highs. So emerging market stocks that historically have a nice high correlation with their currencies should follow through. We just haven't seen it yet. But the fact that EM currencies are doing well, to me, should provide a nice tailwind for EM stocks.
I personally am excited about that because I have a pretty healthy allocation to EM. I've been a little disappointed this year so far. So this is good news. JC, I could keep you on video for the next 4 hours. I won't do that to you though. But this is it's fascinating. I got to have you back. How do people find out more about your work?
Sure. I'm easy to find at allstarcharts.com. Follow me on Twitter at allstarcharts. Any questions that you have, I'm always around, fire it over. I'm thick skinned. I've been doing this Twitter thing for 15 years. So come at me with whatever you got. I've seen worse. I hung out a lot in dugouts and locker rooms and trading floors. So whatever you can come to me with, I've seen a lot worse. Trust me. I probably dished it too. So.
All right, you've got a humidor in the background. What's your favorite cigar?
Oh, I like a nice Monty, or maybe like a Duro Fuente. I like those a lot. I get invited to especially in the old days. These days I can't go as much because I got 3 kids under 3. But in the old days when I had all the time in the world, I would get invited to all these cigar events, and I would hang out with Carlito Fuente and drinking whiskey, and they would pair dinners with cigars. Each plate comes with its own cigar. To me, it was too much. It's like my salad with a cigar, and then my appetizer with a different cigar, and then the main course with another cigar, and then of course you got your dessert cigar. It's man, it's too much.
I do love a good Padron 1926. I also like investing in ideas just as they're getting going, and AI certainly fits that bill. Analyst Stephen McBride from RiskEdge explained to me how to get started with AI, both as an investor and as a user of AI. Check out that video next.